What if I told you the car sitting in your driveway might be part of a £10 billion scandal? A scandal so massive, it could force UK banks to pay out billions in compensation and expose how millions of ordinary drivers were quietly overcharged for years. It started with a dream, the dream of owning a car. For millions of people, finance made that dream possible. A few signatures, a down payment, and the keys were yours. But behind the glossy ads, smiling salesmen, and polished showrooms was a scandal so vast it's been called one of the biggest consumer rip-offs in British history. A £10 billion car finance scam hidden in plain sight. Today we expose how it happened, who profited, and how it affected millions of ordinary drivers. This is the story of how Britain's biggest lenders became trapped in one of the largest financial scandals in decades. A story of hidden commissions, broken trust, and unchecked greed, all disguised behind something as ordinary as a car loan. In the early 2000s, Britain's car market was booming. Dealerships were everywhere. Finance companies promised affordable monthly payments. The message was simple. Why wait to buy your dream car when you can drive it today? It sounded like financial freedom, but it was actually a trap. Behind the paperwork lay a confusing maze of terms. P, C, P, A, PR, guaranteed future value. For many buyers, these numbers meant nothing, but for the car dealers, they meant profit. The personal contract purchase, or PCP, became the dominant way to buy cars. You paid a deposit, monthly installments, and then either returned or bought the car at the end. But what few realized was that brokers and dealerships were secretly inflating interest rates, earning hidden commissions from lenders for every extra percent they added. Here's how it worked. A bank offered a car dealer a base interest rate, say 4%. The dealer was allowed to increase that rate. Every time they raised it, they earned a kickback, a secret commission. Customers thought they were getting the best available rate. In reality, they were being charged hundreds or even thousands of pounds extra, just so the dealer could pocket a bigger bonus. No disclosure, no transparency, and no regulation strong enough to stop it. Between 2007 and 2019, the UK's Financial Conduct Authority estimates that over 3 million car buyers were affected. The total overpayment, nearly £10 billion for families struggling with the cost of living. That hidden interest meant real hardship. I trusted the dealership, says one buyer. They said it was the best deal I could get. I ended up paying £5,000 more than I should have. And she's not alone. Thousands of drivers across the UK, from London to Leeds, from Glasgow to Cardiff, all tell the same story: misled, overcharged, and ignored. Something hidden. Dealers and lenders were secretly earning commissions not for helping customers, but for charging them higher interest rates. That's right. In some cases, the more interest you paid, the more money the dealer made. It was a conflict of interest buried deep in the fine print, invisible to the average car buyer. According to investigations later reviewed by the UK's Financial Conduct Authority, this system allowed brokers and car dealers to manipulate interest rates while lenders looked the other way. Imagine this. You walk into a dealership ready to finance your car. The dealer tells you they've found the best rate. But what you don't know is that the dealer has the power to increase your rate, pocketing a larger commission. In other words, they profit more by making you pay more. And for years, nobody told you. By the late 2000s, this practice was widespread. Almost every major car finance provider was using these discretionary commission models. But the truth doesn't stay hidden forever. Consumer advocates and financial watchdogs began to notice strange patterns, car buyers paying thousands more in interest than expected. One of the loudest voices was consumer champion Martin Lewis, whose platform MoneySavingExpert.com started encouraging people to check their car loans for possible mis-selling. Within months, over 1 million complaints were filed. 1 million. The volume was so overwhelming that the Financial Ombudsman Service had to pause new cases, waiting for regulators to decide how to handle what was now a national crisis. What started as a few whispers had turned into a full-blown scandal. In early 2025, the Financial Conduct Authority, FCA, launched a major investigation. Its findings were staggering. According to reports from Reuters and The Guardian, the regulator found systemic misconduct. Lenders had allowed commission structures that directly incentivized dealers to overcharge customers. This was more than a few bad actors. It was an industry-wide failure. The potential redress? Between 8 and 10 billion pounds, one of the largest consumer compensation schemes in UK financial history. Some analysts even called it the PPI of the 2000s and 20s, comparing it to the infamous payment protection insurance scandal that cost banks over 40 billion pounds. Banks, of course, denied intentional wrongdoing. Several major lenders, including Lloyds and Barclays, stated they had followed the rules in place at the time and were cooperating fully with regulators. Still, the financial ombudsman began upholding consumer complaints one by one. And as more cases piled up, the pressure on lenders mounted. By mid-2025. Lloyds Banking Group had already set aside an additional £1.1 billion to prepare for potential payouts, with more expected to follow from other banks. Behind every number is a story: families who struggled to afford payments, drivers who trusted the system only to find out years later they were being overcharged. Many victims say they would have never taken the loan if they'd known about these secret commissions. Some discovered they had paid thousands more than necessary just to help a salesperson earn a bigger bonus. For them, this isn't just about money, it's about trust and how easily it was broken. As of late 2025, the FCA is preparing a nationwide redress scheme, expected to begin in early 2026. Banks may face billions in payouts, not from a sudden market crash, but from years of The system was designed that way, to keep people in perpetual debt, to make ownership feel possible while keeping true freedom just out of reach. It's the perfect illusion, and for years it worked flawlessly. But now, the truth is out, and with that truth comes power. Drivers are reclaiming their money, and more importantly, their awareness. Financial literacy, transparency, and accountability. These are the real weapons against exploitation. Because when consumers know the system loses its grip. The £10 billion car loan scam reminds us that behind every signature, every deal, every special offer, there's a business model, and it's not always built for your benefit. In the end, the victims were ordinary people, but the lesson belongs to all of us. Always ask, always read, always doubt what seems too easy, because in finance, as in life, nothing truly comes free. Who really paid the price? Quietly accepted misconduct. The scandal has forced regulators to rethink how consumer finance works and how easily everyday products can be twisted by greed. It's a painful reminder that in the world of money, deception doesn't always look like a Ponzi scheme. Sometimes it looks like a simple car loan. If you found this story eye-opening, hit the like button and subscribe for more deep dives into billion-dollar lies, scams, and scandals. Because next week, we're uncovering another story where money, power, and deception collide.